Hello, everyone. 8 p.m. Eastern on Wednesday evening can only mean one thing. It is another edition of Taxes in Retirement. I am Andy Panko, your host and moderator of the Facebook group through which you're watching this, Taxes in Retirement. Special great guest tonight. He's been on before. He and I are coaches / mentors / faculty in the Roth Retirement Club, which is a really cool membership group for people in or near retirement seeking community and knowledge about all things retirement planning, life planning, financial planning, tax planning. It's not just numbers. It is, like I said, life planning and finding purpose and meaning. And that's really our guest today. His specialty is retirement coach and helping people find purpose and meaning and satisfaction and fulfillment in retirement. So without further ado, let me bring back to the show Kevin Lyles, retirement coach extraordinaire. Hi, Kevin. How are you?
Doing great.
Thank you again for joining. Super excited for this one here. So tonight's topic is right in Kevin's wheelhouse. We're going to discuss risks in retirement, and we're going to do it twofold. There's going to be financial risks, things that we frequently talk about in the group. And then I don't want to say more or less important, but very important is the non-financial risks, some of the sort of the life things, again, the meaning and the purpose, which is really Kevin's specialty. So I'm looking forward to that. Kevin.
I'm ready. Hit me with one.
You knew they were coming. All right. So I was abducted by aliens. They made me wash my hands, clean my room, and eat my vegetables. Turns out I was on the mothership. Right? Yes, sir. Little known fact, before the crowbar was invented, crows simply drank at home. You know, they got to get their libations in somewhere. And finally, I told my friend I'd built a model of the Himalayas. He asked to scale. I said, no, just to look at. You know what I'm saying, Kevin?
We needed to lighten it up. It seems like a heavy time in the world right now, isn't it?
Oh, man, it's terrible. Little more brevity. So I am wearing an Ohio State shirt, and this has double meaning tonight. So Kevin is from Ohio, and a member of the group that I had a chat with a few weeks ago, super nice, lives in Ohio, sent me this shirt. So I said I would wear it, and here we go. Works out well that Kevin's on, and Kevin's an Ohio guy. So go Buckeyes, right?
If I knew, I would have had my Buckeye shirt on.
And before we get into it, Kevin, let me just hit everyone with a disclaimer here. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which neither I nor Kevin are. We are just two fellows here talking about retirement risks this evening. Ain't that right? Cool. Let me just see. Comments are working. Yes, comments are. Okay, Cody Garrett says, Kevin Lyles is my favorite. Don't tell the others.
Hi, Cody.
And David Fultz, for those about to rock, in parentheses, retirement, we salute you. Cool. All right. So Kevin has slides, which I will pull up. Very nice, short, to the point slides. And he and I, well, he went over this, but he and I were both at the Roth Retirement Club, has an annual rodeo. It was in October of last year in Fort Worth, where members go, and then Kevin, I, and a handful of other faculty go. And it's a weekend-long thing where we talk. There's some sort of formal education presentations. There's some hanging out. There's a roundtable discussion. And one of the things Kevin went through is this presentation here, these retirement risks. So without further ado, I will I'll toggle through the slides here. But the first one, we'll start with the financial risks. We'll do the non-financial afterwards, if that's okay. So Kevin, maybe start us off. The first risk of longevity.
Yeah, you know, retirement planning would be easy if we knew when we were going to check out, wouldn't it?
Yeah.
The hard part, I think, about longevity risk is it's two-sided. If you plan for too short of a life, you could run out of money in your old age, and that's not good. But if you plan for too long of a life and you don't spend very much money, then you die with a lot of money and you left life unlived.
Right. Now, how do you propose people address this, right? Like, I think everyone, the goal will be to die with a penny left in the bank, you know, minus whatever other inheritance or whatever you wanted to leave behind. But to your point, we don't know when we're going to pass. So how kind of any basic broad stroke planning or ideas for people to approach longevity? risk?
Yeah, there are several ways you can do it. It comes down to your retirement spending style. I happen to be one they call the safety first style. So I have some guaranteed income sources coming in that will last for the rest of my life. So I don't really have to worry about the longevity. So you can buy an annuity and pool that longevity risk with a bunch of other people. And that's one way to do it. But if you're just what they call the probability based and you're just living off of your portfolio of money, one of the things you can do is put a little bit of it aside and buy something like a QLAC. Have you talked about those here recently?
Not recently, but we have. It's a deferred annuity you buy within an IRA, essentially, right? To start the income later.
Yeah, and it starts when you're 80 up to 85, you can start it. And so that's one way you can deal with it if you're just trying to manage it on your own.
Got it. Okay. And I'm sure we can dig into each one of these topics for an hour. So we'll just kind of march through them and then save some time for questions at the end. Next one, big one right in everyone's face right now, market volatility and sequence of returns.
Yeah, well, the sequence of returns is the part of that really affects retirees, because once you start spending from your money, that average return that you've always put into your planning documents no longer applies, because you don't get 7% a year every year. You'll have one year where it's up 24% and the next year where it might be down 18%. And if you have a bad sequence, if when you retire, either shortly before or shortly after you retire, you have a lot of bad returns, your portfolio can get so depleted that it never has a chance to recover when the market goes back up, as it inevitably seems to do. But it's not a good situation. So there are a couple of ways that I talk to people about doing it. One of them is called time segmentation, or more popularly, a bucket type strategy, where you have some money set aside in cash, your cash-like investments that you can spend while the market's down, leaving your stocks alone. If you don't sell those stocks when they're down, you didn't suffer the loss. So that's one way to do it.
Right. And that's important to know, that averages don't matter in retirement. When you're accumulating, sure, you can think about your returns as averages. But I've seen some planners who don't focus on retirement planning. Their back of the envelope process to figuring out distributions or retirement readiness, or whatever, is you have a portfolio of X. Let's assume you're going to average 6% returns on that. So long as you're taking out less than 6%, you're good. And we all know, no, it doesn't work because of the sequence. If you have a few really bad down years in the first few years, to your point, you're taking money out of your portfolio, kicking it when it's down, having that many less shares left to rebound when the rebound does happen. So you may not never catch back up. So it's important to be aware of this and think through and have an approach like the bucketing, the time segmentation, so you're not selling out of depressed assets when they're down. You have something like cash or some other buffer type asset to pull from.
Andy, it's one reason I don't like target date funds for retirees. I love it when you're accumulating. It's very simple. You throw all of your money into it. They manage the asset allocation for you. But once you're retired, if all you have is a target date fund and the market's down, well, you have to sell stocks to live. Yeah. And so that's why I like people to get out of those. Another point I would make is a lot of people get pretty simplistic and with their investments, and I generally like that. But it's really important as a retiree to stay globally diversified and diversified among different asset classes. Why? Because asset classes tend to run in long cycles sometimes, and you'll have, for instance, the S&P didn't go up from 2000 to 2010. It was flat. And if you had if that's all you had was an S&P 500 fund, you really suffered that decade. Whereas had you had a diversified portfolio with some other international value type funds in it, then you did fine during that decade. So you really need to think about diversification, because you can't stand as a retiree to have 10 years of down when you start your retirement.
Right. And that's important. I know diversification is more than just different types of stocks. It's different asset classes like fixed income, like dare I say, possibly crypto if you're someone who believes in it, or real estate, or whatever it may be. But just quick comment about US versus international. So like you said, the first 10 years of this century, this millennium, US stock market, as measured by the S&P 500, was roughly flat because we had a hellacious few years to start the 2000s. International stocks did better than US during that 10-year period. Now, the most recent 10 years, completely different story. US stocks trounced international. So it's been a hard sell to explain to people you need international diversification when they say, wow, the S&P's crushed it, which it has. But now going forward, that's the whole thing with investing. It's about what do you think may happen, or being diversified for going forward for whatever does happen, as opposed to looking behind. The US stock market has run up so incredibly much over the last few years. Even though S&P is down 10-ish% now, it should still probably come down some more, frankly, to cool off from where it was. Going forward, who knows? Will US do better than international? There's a lot of weird stuff going on in the world now. So it's anyone's guess. But considering how high US stock markets run up, there's a really strong case to be made that there's more room to run for international going forward. Anyway, let's not make this an investment show, but I think that's important to know. Diversification ultimately matters. Long-term care expenses. This is a big one and often top of mind for many people I speak with.
Yeah, and it's a tough one because there aren't easy solutions here. The insurance market for long-term care has really, I think, gone against retirees over the last decade or so. What happened was 10, 20 years ago, most of the long-term care insurers underpriced their products. And so they sold these long-term care policies to people. And then they found out, well, they weren't charging enough premium. So as they increased their premiums every year, like insurance companies do, just like our homeowners, our car insurance, those premiums tend to rise over time. So did long-term care. Well, that can be a real problem for retirees who are living on a fixed income. And some have seen huge premium increases. So the other thing they did, it used to be easy to buy a long-term care policy that had, say, a 5% a year adjustment, annual inflation adjustment, and that had unlimited benefits, meaning as long as you need long-term care, they would pay for those expenses. Yeah. Those policies are becoming harder and harder to get. So I tell people, just do the best you can. You need to decide, do you have family that can help out? Family members provide a lot of long-term care in this country. If you can afford some insurance to keep your family from having to do it, I think that's a great situation to be in, but not everyone can. There are some new hybrid policies that you can get either with a life insurance or an annuity wrapper that will let you take money out of those policies for long-term care expenses, but you're just really transferring your own money there. So you might as well just set aside a piece of your portfolio for long-term care. Home equity is a big solution for a lot of retirees because they have a lot of wealth built up in their homes. And as you get older, if you have to move out of your home, you can sell the home and use that equity. Or if you're still in your home, perhaps you can use a reverse mortgage and create some income to cover some of those long-term care expenses.
Right. Great ideas regarding pure long-term care insurance. I agree. I've seen policies where premiums just go up. I don't want to say astronomically, but go up substantially. I've seen in one case, premium was fairly stable for a handful of years and then just jacked up recently. And the person got the statement and it gave him different options. You can keep the amount of coverage you have, but your premium's going to be, it was like close to doubled. Or there's some alternatives. You can keep it, but without the inflation increase. You can reduce the amount of coverage, et cetera. So what he decided was, let me reduce the coverage. So you don't need to necessarily insure the entirety of your long-term care expense, which could easily be hundreds of thousands of dollars down the road. Maybe just get a little something to take the edge off for less premium. So that's everyone's situation is different, but that's one way to consider it. You don't have to fully cover it. Maybe you just get some.
Yeah, and Andy, you made me think of, this whole area is too complex to learn on your own. So get an independent broker who deals with long-term care insurance to advise you. That's going to be the best way to figure out if a policy is any good or not, if it's affordable, those sorts of things.
Definitely. Yeah. No, great recommendation. Because there's people, this is a very complicated product. There's people, this is all they do. They know the ins and outs. They can shop around different providers, different insurers, etc. All righty. Next. Oops, sorry. Healthcare and prescription costs.
Yeah, the reason people get into trouble here is a lot of people have had their health care subsidized by their employers, and they're paying very little. So they don't really have a good feeling for how much health care insurance costs. Then they go on Medicare, and I don't know, I saw it was a survey, and it was a pretty high percentage, maybe 30 or 40% thought Medicare was free. And it's really not. There are a lot of costs to it. You need Medigap or Medicare supplement policies sometimes. And that's really important, because one big difference between Medicare and probably the health insurance you've had from your job is that health insurance you had from your jobs almost always came with an annual out-of-pocket limit on spending. Maybe it was $5,000 a year, maybe even $10,000 a year, but you knew that was the most you were going to spend if you had the worst medical issues, both you and your spouse, that you could have. You were still, once you paid $10,000, they picked up everything else. Well, Medicare doesn't work that way.
Right.
Medicare has unlimited copays in Part B, which is your physician and outpatient insurance, of 20%. So if you happen to have a medical condition, let's say you get cancer and are going to the oncologist frequently, it could be tens of thousands, if not hundreds of thousands of dollars is your part of that. Right. So that's why you really need to get, again, I think, an independent advisor to help you make Medicare decisions and get a supplement that will cover those out-of-pocket expenses.
Exactly. And that's what I do with folks. I know enough about Medicare to explain the basics of it, but when it comes to shopping around specifics of policies and supplements, it really all depends. Well, it depends on a lot of things, but specific doctors you need, services you need, prescriptions you take, areas of the country you're in or want to be in. And there's various different options for backstop or supplemental or advantage coverage to wrap around the basic Medicare. And you really have to work with someone who does this day in, day out. So same thing. I refer folks to, Medicare supplements or Medicare specialists that do this. And just like Kevin said, there's a 20% what's called co-insurance for Part B. So every expense you have, you're paying 20% of the bill. Medicare picks up 80%. So if you have $100,000 surgery, you're paying 20 grand for it on top of the premiums you pay. So you definitely, in many cases, want to consider some sort of supplemental or additional coverage layered on top of your base Medicare. All right. And just a quick note, I see Cody. Cody, great comment, Cody. So there's lots of things Medicare just flat out doesn't cover, the base Medicare. Hearing aids, vision, dental, podiatry. What's the thing where they stick needles in you? Why am I drawing a blank? Whatever. Chiropractors and man, what's that thing, Kevin? You lay down, they put all the
acupuncture.
Acupuncture, yes, thank you. Like a voodoo doctor. But anyway, so a lot of those things aren't covered, and people are surprised to find out you have to get separate coverage, or you can get one of these other policies that kind of wrap it all in. But yeah, great point, Cody. Thanks for bringing that up.
Yeah, we don't think about our dental because for most of our lives, that's a couple cleanings a year and maybe filling the occasional cavity. But a lot of people, as they age, I've had a couple of family members that it was $10,000, $20,000 of dental expenses, and that can really blow up your plan if you haven't thought about it.
Yeah, definitely. All right, next. Oh, inflation. Haven't heard of it. Is that a thing? Inflation?
It seems to be lately, doesn't it? We've really been for the last 30 plus years without any real inflation to think of, and now we finally got it. And obviously, there's a lot of debates on how long it will last and how high it will go, and no one knows the answer to that. The other thing that really causes inflation to be an issue, I think, is we're living longer in retirement now. If you go back 30, 40 years, say your grandparents, if they retired at 65, they were lucky to live past 69 or 70. Now people are living well into their 90s, if not higher. And so inflation doesn't affect you in the short term typically, but over 30, 40-year retirement, it can really have a huge impact on your costs. So you want to think about how you're going to mitigate that, whether you're going to buy inflation-protected securities, I bonds are real popular right now because they're paying a lot, but you can only put in 10,000 a year per person into those. So that's not a big solution for a lot of people. TIPS have negative return plus the inflation. So you're going to lose money on those, but it's pretty limited what you'll lose. Usually, if you have a healthy stock allocation, over time, stocks will earn more than inflation. But again, I said over time. And as a retiree, you don't really care about over a 40-year period. You care about when you retire in those next few years. So it's a challenging one.
Yeah, and there's no easy fix or product to hedge it. Like you said, I shared an article within the group, and I think Rock Retirement Club a couple weeks back about a Wall Street Journal article about how there isn't a bulletproof way to fight inflation from an investment from a portfolio perspective. I bonds are great, but you can only buy 10 grand per person. TIPS, you're going to lose money unless there's a lot of inflation. Even then, you may not necessarily keep up, and they're more complicated than that. Stocks usually do well over the long term, but in periods like now, in like 70s when we had stagflation, where there's high inflation and stock markets going down, that's a bad scenario. That's very similar to what's going on now. Spike in inflation, stock market pulling back from ridiculously high highs, so it's kind of overdue, but still. In things like commodities, they've been spiking, doing well lately, but more times than not, under normal circumstances, commodities are quite risky and quite volatile. They don't necessarily do that well, at least compared to a more traditional stock and bond portfolio, let's say. During times like now, they do great, but now is not the time you want to buy it. When commodities already spiked and had their run up, you don't want to be, plow money into it now. So it's tough. I mean, frankly, I think the best thing people can do with inflation, if you are retired, is just really rein in your expenses, or not rein in, but control your expenses to the best you can. Control what you can, as opposed to the things you can't. So,
another mitigation factor that a lot of early retirees use is part-time work. And that works because typically wages keep pace with inflation, and so that's something that a lot of early retirees can do.
Yeah, working is in most cases the best solution to improve your retirement finances, long term and short term. Now, for some people, maybe an option, like you said, if you're transitioning out of retirement, maybe stay a little longer in the workforce. If you recently retired, you're still physically and mentally young and healthy, some part-time work. And if you're in your 80s, going back to work, getting some wage income, might not be an option necessarily. So in that case, it's a little more challenging, but definitely, I agree. The ability to earn income is a phenomenally powerful tool that can combat a lot of ugliness. So, all right, unexpected family responsibilities with an asterisk.
Yeah, and it has the asterisk because it really has as much non-financial implications as financial. But let's talk about the financial aspects of it, and that is, one, it can directly cost you money. You need to help pay money to support a family member, for whether it's healthcare or legal problems. It can be a lot of different things can come up in your family. But the other way it arises in retirement is a lot of retirees' plans depend on them working part-time. And if they now need to go provide care for mom or dad, they can no longer work and earn that income that they had planned. So even if it doesn't have a direct cost to them, it has an indirect cost that shuts off that income they had planned. So there are several ways to mitigate this. When we're working, we're told we need an emergency fund, right? And usually we're told we need to cover 3 to 6 months, maybe 12 months wages, enough to get you back on your feet if you lose your job. Well, retirees need a contingency fund. We call it that. We don't call it an emergency fund anymore. I'm not sure why, but you need a fund to pick up unexpected expenses because you no longer have regular income coming in that you pay those things out of. And I've been retired now for a little over 4 years, and we've had 2 or 3 things, nothing big, thank goodness, but $5,000, $10,000 items that we just had not anticipated and we didn't have insurance for. And so you need a fund for unexpected expenses. And these family responsibilities is a big area where that comes into play with a lot of people.
Yeah. So if you're someone who follows a bucketing time segmentation approach, in effect, it sounds like you just kind of lump this extra potentially needed income into the near term, the cash or cash like bucket, right?
Yeah. I mean, and, I even tell people just set it aside separately, just like you do that emergency fund when you're working. Just keep that cash there and you're going to use that. And if once you tap into it, depending on how old you are, and you need to maybe refill that somehow.
Yeah.
And that's not always easy, but maybe you have to give up something you were planning on buying. Maybe you delay a car purchase a few years. Maybe you'd get a part-time job, but you need to have that fund to give you, it's the sleep well at night factor. If you don't have it, you're not going to sleep well because you're always going to be worried about something you weren't thinking of coming up and causing you an expense.
Right. There's a lot of value in sleeping well, right? We often overlook that. Well, me and people of my ilk often just look at numbers and facts and figures, but sleeping well at night is probably the ultimate goal and test of how well are you doing in retirement, or how well is your advisor. The better he or she helps you sleep, right?
We're not rational when we feel vulnerable. And once you retire and you've cut off that income, you feel vulnerable. And so, having confidence in your plan is more important, frankly, than the numbers working out precisely, I think.
Yeah, it makes a lot of sense. Divorce.
Yes. And, I could have added to this list. I didn't, because I didn't want it to be too negative, but death of a spouse. But divorce is one that obviously has both financial and non-financial implications. The financial side, I mean, you can tell that story, but you're in effect cutting everything in half except your expenses. They don't get cut in half. And so it has a huge financial. The non-financial side, though, is worse because you're losing your whole plan, because you had planned to live life together and you had dreams together. But this thing they called gray divorce, it's divorce with people over 60 years old. It has the highest divorce rate, that demographic. And it's, I think it's because in a lot of cases, they didn't really talk about retirement leading up to it. And maybe they had completely different ideas for what a good retirement life would be. Or maybe they devoted their whole marriage to the children. And once the children are grown and out of the nest, find out you no longer have anything in common. So, the best way to deal with your marriage is while you're still working. Don't wait till you retire to start having these conversations. Have them while you're working and get on the same page.
Yeah. Or just when you do retire, make sure you have very different hobbies and do your own things.
Right.
That may be the path of least resistance. No, I'm kidding, of course, sort of. Some people do that, though. They kind of still, because you're used to decades of everyone kind of doing their own thing, whether it's jobs or whatever it may be, and see each other at nights, weekends, and occasional dinners or kids events. In retirement, you're around each other potentially 24 hours a day, so you may need some structure away from one another to prevent butting of heads.
I was talking last night to the author of the book Life 2. His name is Don Ezra, and he has a neat graphic, and it's basically concentric circles. These are my interests. These are my spouse's interests, and they will overlap, but they will not, you need separate things. You need me time, we time. Right. And keep that. And that's healthy for a relationship, certainly.
Yeah, definitely. Not even just retirement. I mean, I think all stages of life, right? All right. Moving on. This is another huge unknown that's hard to kind of put some, handicapping around to figure out what's going to happen. Changing public policy and tax rules.
Yeah. And really, what I like to say about this one is no matter how much planning you do, no matter how good of a job you do planning, there are things simply outside of your control, and that needs to be part of your plan. So, if the tax rates double next year, retirees are going to have a problem, and they could. I don't expect they will, but they could.
Right.
I mentioned to you before we went live that I've been doing Roth conversions, trying to get rid of part of that tax risk over time. People say, well, are you sure rates are going to be higher later? And I say, no, but I don't want the risk that they will.
Right.
So to me, it's a risk mitigation strategy. Public policy is the same thing. I mean, they're just, so many changes that can imagine. And, if you're living in Ukraine now, that's not public policy, but it's sort of global event. So we can only plan as much as we can plan, I guess.
Yeah. I like what you said about Roth conversions, a risk mitigation tool. And David Fultz here says, hope for the best, plan for the worst. That's my view. And I'm in the process of starting to think about writing an article about it, about how difficult it is to try to quantify the real value of Roth conversions, because a lot of it is so dependent on huge unknowns that could have very different outcomes over time. But in my view, I think a fairly sizable portion of the benefit and value of conversions is that peace of mind, is taking the taxability off the table, such that regardless what happens to tax legislation, to your own personal circumstances, et cetera, you don't have to worry about that money being taxed again. And that comes back to peace of mind, sleeping better. So, and there's inherent value in that to different extents for different people, but that is a big part of why you do it. It's just kind of the hedge to future tax risk. You're not guaranteeing you're going to be better or worse off necessarily, but you're hedging. So you have more optionality and protection against whatever the future may hold.
And if you take that approach, it makes it a lot easier to do those Roth conversions. I know, Andy, you spend a lot of time with Rock Retirement Club members helping them, and a lot of people want to get it down to the exact dollar. I need to convert $1,850 this year because they're going to try to get right to the top of a tax bracket and not a dollar more.
Yeah.
Well, the reason they're doing it is they're trying to practice tax arbitrage and say, I'm paying this percent in taxes now to avoid this percent later. Well, we don't know what they'll be later. So I think trying to get precise is really a waste of energy.
Right.
I just don't want the risk. I don't want to have to think about whether the government's going to raise my taxes. So as long as I can afford what I'm paying now to convert, I get peace of mind over it.
Right. Exactly. Great way to view it. Other financial risk, business risks, I guess specific for annuities and pension. What's this one all about?
Yeah, and this, I frankly don't think it's a huge risk, but we've seen a number of pensions go bankrupt. We really haven't seen a lot of annuities go bankrupt, or it's not the annuity, it would be the insurance company that issued the annuity, go bankrupt and not pay off. State regulation of those companies is pretty good. And normally when there have been companies go bankrupt, but normally the state will work with another insurer to pick up those policies and make the people whole. But there are no guarantees that that'll happen. For pensions, there's the Pension Benefit Guaranty Corporation, which is a quasi-federal program that backs up pensions to some extent. And there's a similar thing for annuities at the state level with state guarantee funds. So if you're going to be buying annuities, it makes sense to me. Why not spread them out? Because, if you've got, normally it's $250,000, $300,000 will be insured by the state. Well, why not get annuities in that amount instead of buying one huge annuity? So that's one way to do it.
Yeah. Yeah, it makes sense. And you mentioned the Pension Benefit Guaranty Corporation. Fun fact, well, not so fun, I guess, but that only covers private pensions, like private corporations. If you work for a local municipality, school district, whatever, they're not covered by any sort of backstop. They're covered solely by the town for which you work and its ability to generate tax revenue. And even legislative changes of that town. Are they willing and able to cough up extra money if the pension plan's really struggling? Now, some states, some municipalities are much worse off than others. So this is all going to be situation dependent. If you work for the state, one of these states that's in the bottom of the list of pension fundedness health, maybe this is a legit concern where you do have to keep in mind, okay, my pension is whatever, $5,000 a month. What if it gets sliced by, $1,000 a month at some point? Factor that in as a what if. Okay, what else do we have here? Excess withdrawal risk.
Yeah, this is overspending, and there are a couple reasons you might overspend. One is you've decided on an overly aggressive withdrawal strategy. I guess you could go back to that longevity. Maybe you plan to only live to 80 and you end up living to 95. And so you took out more than you safely should have. So part of it comes down to good planning. But really, what it really comes down to, I think, is just revisit your plan every year, every 2 years, and make adjustments as needed. If you get off plan, you need to get back on plan. You need to cut your spending, increase your income. You need to do something to get back on plan. And that's what I mean by excess withdrawal risk. It can also happen not on the side of how much you're spending, but it's you haven't properly planned your expenses, or some of those unexpected expenses pop up that we talked about, and you didn't have a contingency fund. That can do it too.
Yeah, and in the words of Roger Whitney, the agile retirement planning process, even in retirement, a lot of this stuff is a moving target. I don't want to say unfortunately to make it sound bad, but I mean that's the reality of it, right? Even if you're super conservative at one extreme, hypothetically, let's assume you use all your money to buy annuities and you got a fixed guaranteed payment for life. Sounds good on the surface, but what if your expenses get carried away? What if inflation gets carried away and your annuities, which most don't have an inflation increase? So even that isn't a foolproof guaranteed thing. So you kind of have to adapt, stay agile, as Roger says, and sort of roll with the punches as things happen, whether it's personal circumstances, inflation, financial markets, tax legislation, whatever it may be. Things will change for good, for bad, for indifferent throughout retirement.
Yeah, one change that people don't talk about much or even think about, but are you the same guy, Andy, you were when you were 18?
I'm much better looking now. So no.
I mean, do you want the same things that you wanted when you were 18? No, of course
very
not.
different.
Well, do you think when you're 60 that you'll be the same person at 80? No, we evolve. What we want out of life changes. And so, that's where that agile retirement management process really comes in handy, because not only are you trying to manage for all those unexpected things that happen, just the expected changes like market volatility that can happen, but changes in your own desires and what you want out of life.
Yeah, well said. Frailty and declining cognitive abilities.
Yeah, and this is another one that obviously has huge non-financial implications as well as the financial side. What you do to plan for this one is a couple of things, I think. One, you want to make sure you have people that you trust that are regularly engaging with you and can be on the watch for that. Often, and people think, well, that's my spouse. And yeah, spouses will often pick it up, but they see you every day. They may pick it up late. So you need to have regular sort of check-ins. Maybe it's medical professionals or just people you trust who can find out, are you starting to have declining cognitive abilities? So that's one thing you do. We all tend to start doing this with our parents. And usually what happens is some problems come up. Maybe they've been a victim of elder abuse and have sent a bunch of money to a Nigerian prince. So that's
wait, is that frowned upon?
Not if it's part of your plan.
Yeah, right. Well, it's going to pay off like tenfold. So when that pays off, I'm
Exactly.
good.
You get that $10 million at the end of that rainbow. But another thing you can do is sort of simplify your financial life and your investments so that you don't have to make a bunch of important decisions. Cognitive decline is something that affects almost everyone, except maybe Charlie Munger. You're faced with it to some extent. And so try to make it to where you don't need to do as much, make as many important decisions. Make sure you've got your powers of attorney, your wills, all those documents in place.
Yeah.
And, the other thing, and this is the fun part, I'm doing it now in my early retirement years, have an active, healthy lifestyle. That's the best thing we can do, both for physical decline as well as mental decline.
Right. Yeah. Oh, great words of wisdom. Already touched on this, but financial elder abuse.
Yeah. And, start with your parents and just make sure, especially our parents' generation, for those of us like me who are baby boomers, and I don't know if it still applies to your generation, Andy, but, we don't talk with our children, and our parents don't talk to us about what they have, what their wishes are. We need to get over this. It's just too important to not have these kinds of conversations. And you want your parents to be able to tell you, because I've seen it in my own family. They got a call Oh, someone needs help. Well, if you're having regular communications, maybe maybe you can ward that off before it happens.
Right.
So that's the best way. If you are alone and you're the elder in this case, that's where you really need to have a trusted contact. Maybe it's someone at a bank, maybe it's your financial advisor who you consult before doing anything significant financially.
Yeah. Yeah, definitely. And that's something I do with everyone is ensure they have at least one trusted contact who the custodian is allowed to talk to ask about the whereabouts, or if they suspect the person's a victim of abuse or doesn't have their mental faculties with them. Very important to do. Changing housing needs.
Yeah, this is another one that, where you live has such a big impact on your retirement life. It's bigger non-financially, I think, than financially. But the key here is not to wait too long. I think what happens to a lot of people, most retirees want to stay in their homes. That's what they report as long as they can. Or many people will say, until I die, I'm going to stay in that house.
Mm-hmm.
And the reality is many of them can't. And so if you wait too long to make the change to a better living situation, it's much harder to make the change and do it. It costs a lot more the longer you wait. So just try to think about where you're living now. I'm now in a house. It's a house on stilts because I'm in a hurricane zone. Well, I don't know that I want to walk all those stairs when I'm 93.
Right.
Right now it's great. It's exercise, but in 20, 30 years, it might not be exercise. It might be a real burden that I don't want. So think about that. We talked earlier about using reverse mortgages to get at some of your home equity. There are lots of things like that you can do. And a lot of research coming out now saying you can use that as your contingency fund, if you will, if you've got a big home equity line of credit or a reverse mortgage line of credit, a HECM line of credit.
Right.
So there are lots of things you can do, but another point I want to make, this is sort of off point, but it's on the housing point. A lot of people say, I want to leave the house to the kids. Well, guess what? Your kids don't want your house. They really don't. And so, don't try not to have emotional attachment. I say that realizing we all have emotional attachment to where we live, but try not to do it and try to fight that urge and think about what's the best both location and living situation for you at various stages in your retirement.
Yeah, and not only a house the kids don't want, but a house where the attic and basement and closets are full of random stuff accumulated throughout 50 years, right? So now your kids have to go through that and most likely throw it out probably.
Exactly.
Yeah. What else? Okay, last one here. Forced early retirement as a financial risk.
Yeah. So, what if you've done everything right? You've planned properly, and then you're 5 years from retirement and you lose your job. And we've certainly seen that happen. We saw it happen a whole lot in 2020 and early parts of 21 with COVID. And, in the Rock Retirement Club, we had a series of meetings for people because we had 70 or 80 members who had been affected by that. So the key, I think, is being resilient. It's going to happen. You need to be adaptable. And there might not be a great solution, but they're usually okay solutions if you don't take it personally that you've lost your job. Some people get angry. I worked for this company for 30 years, and now, right as I'm getting in my prime years, they let me go. Well, companies aren't loyal. They're just not. And so don't get emotional about it. It's about them running their business. It's not about you. So you don't need to feel angry. Don't feel ashamed that you lost your job either. Some people go into hiding almost. That's not a good response. Just develop a new plan. And maybe it's a couple of part-time jobs if you can't get a full-time job at that point. Maybe you're ready to retire and you needed that push out the door to get you to go. So just react and be resilient when it happens. And that's the best we can do with that one, I think.
Yeah.
Well, one other, keep up your skills along the way. Too many of us let our skills diminish when we're seeing the end line, and don't do that. Stay current, interacting with younger people. Because if you're out looking for a job, those things are going to help you.
Yeah. Stay employable, keep skills and traits that employers are going to want. All right. The non-financial risk. I'll just, in the interest of time, I'll just pull up all the, have up all three. Let's, I guess, just start with loss of identity. This is a big one, right?
It sure is, because you've lost your role as a worker and whatever you did. And the higher we are in status, the more this tends to affect us in our jobs. And so you're losing your role as a worker. You're losing your role as a provider for your family. If your children are going out on their own now, your role as a parent is changing. So retirement tends to come at a time when we really are wondering who we are anymore. We've lost our very reason for being. And so you need to think about a new identity or identities that you want in retirement. And there's a lot of things it can be. It can be simple. It can be a grandparent. Maybe you're going to identify primarily as being a great grandparent, or maybe it's as a volunteer. Maybe it's being a mentor to younger folks on the job, or maybe it's children. Maybe you're going to be a lifelong learner and you're going to go back and take college classes. That can be your new identity. It can be identity around your hobbies. But just be thoughtful about this one and think about when someone says, "What do you do?" You want to have an answer for them, because in the past you've said, "Well, I'm a financial planner." You're not going to say that when you're retired. So think about what your identity is going to be and how you're going to hold yourself out to the world.
That's a great one. Even as simple as you just jogged something in my head here. When you ask, what do you do when you're working, normally like, oh, I'm a lawyer, I'm an accountant, I'm a cabinet maker, I'm whatever. In retirement, what do you say? I mean, I guess you could just commonly say I'm retired, but like, that's a good exercise for you to think about who you are, who you want to be, what you're going to identify as. And that's your answer. When people say, what do you do? Well, there you have it. I volunteer for XYZ, or I'm the best grandparent on the planet, or starting up a second business. Actually, this is increasingly more common now, as retirees starting up some like little business, nothing crazy onerous, but like a little kind of hobby business, right? Something they're passionate about. So maybe that's it.
Yeah. And if you just say I'm retired, that tends to really stop the conversation. Whereas you say, I like to help people transition into retirement, then you can usually have a discussion about that. So it's important. And it's important how you feel about yourself.
Right. Which ties into lack of meaning and purpose. Right?
It sure does. Our jobs give us a reason to get out of bed in the morning, right? They give us a sense of utility, significance, and status. And when we lose that and retire, a lot of people withdraw from the world. And that's the last thing you want to do. You want to find things that are important to you, that give you meaning, that are meaningful to you. And in purpose, when we're talking about purpose, we're talking about things that will help either another person, place, or thing. We've got one of our club members who hikes trails in national parks and picks up trash. That's a purpose. He's helping his world, and he loves to hike, so he's getting exercise and out in nature. But you really want to think about what skills, what talents, what unique gifts do you have, and how can you apply those? How can you make a difference in your world? And I said your world instead of the world, because a lot of people get hung up on this one and think, well, I need to do something grand. I need to join Doctors Without Borders and travel the world to do it. You really don't. It can be in your neighborhood. It can be a kid that lives down the street from you and making a difference in their lives by being a mentor and maybe tutoring them or whatever they need. This can really give you a fulfilling retirement if you do these things.
And I just had a thought, even equating this to my own life. I guess you can use one of these things to overcompensate for the others, right? So thinking about like my own career prior to leaving and starting up my financial planning business, worked a lot. For the most part, enjoyed it, but was far from really soul fulfilling and satisfying and meaningful and purposeful. I had an identity. I mean, I didn't consider, I was always first and foremost like a woodworker, a cycler, a parent. I never has my job as my identity, but it always kept me busy. I was always doing something. And so I didn't have fulfillment meaning, purpose in my job. It was just, I wake up, I go through the motions, I do my job, I get a paycheck, I come home. I wasn't bored because of it. So I guess in retirement, if your job accounts for one or all of these things and it goes away, you no longer have this compensating mechanism where, your job is carrying all four of these things. You have to intentionally find what's going to check each of these four boxes here, right? And really think about it.
Yeah, that's exactly right. And you're right. Don't wait till you retire to start thinking about these things. Think about what is your purpose and make sure you've got your priorities that are lined up consistently with your values.
Yeah.
You talked about being a parent is important to you. How many people are skipping, children's sporting events or plays or what have you because they're working late at night? It happens to a lot of us. And so those priorities, the earlier you start in life, the easier it'll be when you make the retirement transition.
Yeah. Boredom. This is probably the one I fear the most. I mean, I can't sit still. I always need to be doing something. So I like to think I'll find things to fill my time. But I can see if I didn't have gainful employment or self-employment, it'd be a struggle to fill my day.
Yeah. Well, what are you going to do every day when you have nothing that you have to do?
Yeah.
And I'll tell you, the first few days of retirement, that's a wonderful feeling. And very soon, that's no longer a wonderful feeling. It becomes a stressful feeling. So I think the key here is to have goals and ambition. Most of us had that during our career because we wanted to do well at work, whether it was to get that next promotion or, if you're a house builder, to build that great house, whatever it was, you had goals and ambitions around it. And we don't take that same methodology with us into retirement. And that's the way you can avoid boredom. You can have goals around hobbies that you have. Maybe it's sports, maybe it's artistic endeavors. Have some goals, and that will keep you going, and you won't be bored. I have always, do you know Wes Moss? Have you ever listened to him on the radio or on his podcasts?
Know who he is. Yeah.
Okay. Well, he calls them core pursuits, and he says you need 3 to 5. And frankly, I do. I always try to have that many different things going on, whether it's, it's retirement planning, it's my own health and wellness, trying to exercise and eat better. It's hobbies that I do. I play golf, I play pickleball, things I do with my wife. We like to travel. We like to go to spectator sporting events together. And so if you've always got a number of those kinds of pursuits, then you're not going to be bored.
Right. And you're quite the pickleball ringer, I understand, right?
Not so, but I sure enjoy it.
Yeah. And social network. And this one's big. Again, I'm not retired, but I did leave the workforce I knew for 20 years. And this one, I didn't realize how important my job was in relation to my social network. So I don't regret leaving the corporate world to start what I started, but I do very much miss being around people. I worked in Midtown Manhattan. I commuted with a lot of people. I walked the city with a lot of people. I was in large offices for large companies with lots of people. And you don't realize even the casual conversations and just saying hey to someone walking to the bathroom every day. I don't have any of that. I'm in a small office. There's a handful of other single room offices. Everyone kind of does their own thing. A couple times a week, I'll see someone in the hallway. I'll say, hey, but that's it. Work was a large part of my social circle. And now I have to concentrate more and put more effort into making plans with people and really getting actively engaged with friends locally because I don't have it organically anymore from working.
Yeah. So you're getting a dress rehearsal for retirement because that is what it's like. And I want to tell a truth to your audience tonight. The truth is either you are going to die or move away, or your friends are going to die or move away. Eventually, there are no other options. And so in retirement, you're going to have shrinking social networks. You've already talked about, Andy, the loss of your network from your coworkers on your job, but even your personal relationships are going to change. And so you need to proactively offset that. And what are you doing now? What are your top 3 ways that you're staying socially engaged?
I still have I have two kids, they're 12 and 14, very active in competitive dance. It's like the, travel soccer, travel baseball. We do travel dance basically.
Mhm.
So my wife and I, our social network is largely now other parents of, kids that dance. And I see what's going to happen. I've talked to other people who have gone through it. When your kids move out, they go to college, whatever, your natural social circle for those that have kids was typically based around your kids and what they did.
Yep.
And that goes away. And we still have a handful of years till it happens, but I can see how and when it happens. So that's what we do. Lots of friends through kids. I even had, I in close enough to the same town I grew up in. I have a few local friends from high school, and just really make it a point. And even advisors, people I meet on LinkedIn, on Facebook, if they happen to be in or around New Jersey, I do meet up with them. There's one guy that lives 45 minutes away. He and I make it a point to meet up once a month. Another advisor who quit the corporate world to start his own thing, same time I did. So he and I now have become good friends, but we're intentional about making sure we stay friends, about making sure we see each other. And it's working out well so far, thankfully.
Yeah, those are great ideas. And in retirement, frankly, I found it really easy because most people who are retired realize they have this issue. And so they're a lot more open than just common working folks to making new friendships. And, let's go have lunch. When I was working, I didn't go have lunch with someone I had just met.
Right.
It was too important who I was having lunch with, right? But when you're retired, you do that all the time, with your pickleball buddies or whoever. Hey, let's go get lunch. And so people are really open to it. There are also tons of interest groups out there that you can join. So whatever your hobbies, and I mean whatever your hobbies, there are lots of people who are willing to do that with you. So there's a lot of ways to do it. The key is just to be proactive about it and to do it instead of becoming isolated. The people who fail at retirement are those who withdraw from the world and don't engage.
Now, what do you think about introverts? And we'll wrap it and take some questions here, but do introverts have problems with this? Because they sort of by design or by nature will sort of isolate. Do you find introverts come out of their shell more in retirement, or do they really struggle with this isolation?
I really think introverts do better because usually they're more comfortable with their own company, but they need to do it. But hey, the answer is go hang out with other introverts. You don't want to go out with the life of the party because you're going to be uncomfortable with that person. So find like-minded people who enjoy the same things you do. If you're someone that says, look, I'm completely content to sit and read a book. Okay, join a book club. You can still read your books, but then you can go talk about them and talk to other people. So there are lots of ways for introverts to do it. And so I don't really think there's much different. Often it's the extroverts who have to be the life of the party. And then once their work is gone, they no longer have a party to be the life of. So they struggle a lot sometimes.
Yeah. No, I get
or
it.
they move to the villages and have fun. So that's always a possibility.
And my mom moved to sort of the western half of the country, equivalent of the villages. She just pulled the trigger, bought a place in Arizona a couple of weeks ago. She'll be staying out there full time now. She's super extroverted, needs nonstop interaction and involvement, doing things, and she found the absolute jackpot of places between, community center, clubhouse, constant enrichment series, and card games and movies, and just a bunch of random people. They'll meet up. She took a enrichment series about the founder of Arizona just to go sit and learn and do something, and made two friends there. And now she goes out to dinner with them regularly. So.
Oh, that's wonderful.
She's loving it.
I hope she thrives there. And, there's a lot of research that says you can add 7 to 10 years to your lifespan by having those kinds of relationships.
She definitely found the right spot, perfect for her. Difficult to move away from New Jersey and grandkids, but my kids are kind of older now. So, but neither I nor she, I think will regret that move. It's definitely where she's her right fit. So. Okay, let's take some questions here. Going back, here's one from Bruce about Roth conversions. You said you're converting for peace of mind rather than worrying about future tax rates. Are you converting to the top of a tax rate as long as you can afford the taxes? I'm safe with regards to pensions as I don't have any. So conversions, kind of what's your stopping point and why?
Yeah, right now I'm going to the top of the 24% bracket because there's that big jump from, what is it now, 24 to 32?
Yeah.
And, when the taxes revert back in in 2026, that jump will even be higher. So I think you want to look at the 2 or 3 jump points. It goes from 12 to 22,
Yep.
and then it goes from 24 to 32. So, either one of those, depending on your income and how much money you have in tax deferred vehicles. And I just looked at how much I wanted to convert over the number of years I wanted to convert it, and figured I could get that all done staying within the 24% bracket.
Yeah. And Bruce, for what it's worth, Kevin, in my experience, is one of the more aggressive viewpoints about conversions. He wants to completely convert by the time he's 70. And not to say he's wrong for doing that. That could very well end up being the best answer there is. In hindsight, we'll know, but that's him. Other folks aren't that interested or aren't that concerned about taxes, or don't value the peace of mind of having conversions done as much as Kevin does. So just because this is not advice, just because he's doing 24 and trying to get rid of all tax deferred money, doesn't mean that's right for you or anyone else listening. Bruce, just want to put that out there. This was in regards to pensions. I suppose when we talked about the PBGC for national, and then local states and stuff don't have that. They're just subject to the tax raising abilities of the state. So union pensions within the Pension Benefit Guaranty Corp, there's kind of 2 pools. There's one pool that backstops single employer pensions. Like if you work for IBM, GE, whatever, they have their own pension just for their employees. If you work for a union, then it's the union who provides the pension, not the employer you happen to be working at, at the time you're working there, whatever your job may be at the time. As of a few years ago, the pot of money that backstopped union pensions was much more strained than the pot of money backstopping single employers. But as of last year, I forget the exact fundedness, but it was much, much healthier, the union system. I'm not aware of any unions that have default or had to hand over their pensions to the PBGC. I'm sure there have been some. I just don't know of any. So you have to look up your particular pension. You can just kind of Google PBGC and your pension, your union, your pension, and just see what you can find. The information is probably out there. But pensions historically have been a more strained PBGC pot of money than single employers. But that doesn't mean you necessarily have to worry about your union pension stiffing you at some point. Okay. Other questions? Let's see what we have here. Let me get that off. David Faltz. I don't know if this math is accurate, but 1 minute of exercise equals 7 minutes of additional life. Have you heard anything like that, Kevin? Like to quantify?
I have seen some of those. I'm not sure which trade I make there, because I struggle sometimes. I need my exercise to be fun. I'm not good to just do work and have that self-discipline. It's one of the reasons I like pickleball so much. I get a lot of exercise and have fun doing it. But yeah, I mean, there are lots of studies like that show, it's whether you hear it's 60 minutes a week, or even now, some of them are saying 30 minutes a week of moderate exercise can extend your life quite a bit.
Yeah. I definitely believe it. Pat says her kids, or maybe it's, I don't know, but my kids will sell our house the minute we pass.
Yeah, they don't want it. They really don't in most cases.
Pretty common, right? Sounds like elderly friendships are like friendships when we were younger and had lots of time to spend with our friends.
Exactly right. Exactly right.
It all comes full circle, right? And that's exactly what my mom's doing. There's no work. She said it's like permanent vacation. Now, who knows? Maybe that will get old at some point, but every day is a mix of lunches or dinners or movies or mahjong or lawn, grass bowling or lawn bowling, enrichment series, and all with lots of friends around, all in the same stage of life, all doing the same stuff, all more or less without a care in the world. Some people have medical issues or possibly financial issues, but outside of that, yeah, it's just kind of doing fun stuff. And man, it sounds awesome.
Yeah. And one way the elderly friendships are even better than those we had in our youth is most of us have developed empathy throughout our adult lives. And as an example, so I had finished playing pickleball, a buddy and I today. We had played 4 or 5 games. We were tired. A friend of ours who I believe is 88 now, who's been struggling with his health, came in and wanted to play a game. Well, we got up and played one more because we realized it was important to him to get that game in. He was only up for 1 game today, but you have more empathy. You understand if you're not in that situation now, you may be tomorrow. So I just find making friendships in retirement so easy.
Yeah. And I guess along with empathy, but tell me if I'm wrong, but my guess is there's a lot less clickiness, pettiness. Like when you're in high school, right? There's cliques and people are still developing mentally, and friends can't cross over easily, right? In retirement, is that much less the case? Hopefully.
I think so. Although I've heard of some pickleball communities where, people really look down their nose at less talented players. It's not the community I'm playing in now, but I've heard it can be pretty cliquish. So I don't know. I guess sometimes some things we never grow out of.
Yeah, I guess for some people, once a jerk, always a jerk, right? Mariel says, I highly recommend taking Osher Lifetime Learning Institute classes. Many colleges, universities. Have you heard of these before, Kevin?
Absolutely. Yeah. They're in almost every state, they have colleges where they do them. And it's usually other retired folks leading courses for whatever they did during their career. And you name the topic, they have them. Another similar idea is in Ohio, where I'm from. Once you're over 60, you can take classes, non-credit, but you can audit classes in universities for free. So you can study anything you want for free. So
just that's like Ohio State, just the public colleges?
I'll be sitting in there with 18-year-olds. Absolutely.
Okay. That's cool. Cliques and drama are independent of age.
That's true, Alan.
All right. And one more technical Roth conversion question. We'll see what your thoughts are on this, Kevin. How far up the IRMA, which is the Medicare premium surcharge, how far up the IRMA scale is advised for a Roth conversion?
Yeah, well, I'll let Andy take this one because I'm trying to get them done before I'm 63. I retired at 55, so I'm hoping to have all of my conversions done before 63, so I don't have to worry about it.
Yeah, my answer is it's a resounding it depends. Now, there's lots of factors that go into the consideration of how much do you convert, or do you at all, and how much and when. IRMA, the Medicare surcharges, are definitely something to be factored in. They start mattering when you turn 63 in most cases. My general thought is it depends how large of a future tax burden you have. How big is your tax deferred pot of money? Or how strong are your personal views about how high taxes are going to go. Some folks are convinced that taxes are going to be 30-40% effective rates for middle income people. I don't see it happening, but who's to say I'm not going to be wrong? Other folks aren't that concerned about it. So if you're of the opinion that taxes are going to be hellaciously high, that's going to push you to do more now. So you're going to be probably willing and able to pay more taxes now to get yourself more IRMA surcharges now as a result, whereas other people, no. For what it's worth, the first band of IRMA isn't that much. What is it, $60-70 a month now this year or thereabouts? I wouldn't let that stop you. The second band of IRMA, for what it's worth, that's when things start to get a little more noticeable. Then it's like $170 a month of additional premium for Part B, another 30-ish on average for Part D. So you have to think about it. I wouldn't necessarily let IRMA stop you from doing conversions, but definitely keep it in consideration so you're not taken by surprise. Kind of a cop-out answer, but I think that's kind of the best way you can really address this.
And Andy, I also was thinking about IRMA on the back end because once all of my guaranteed income kicks in, I'll be in IRMA. And that's one of the reasons I don't want additional RMDs coming in to take me to a higher IRMA bracket later on in retirement.
Yeah, if you have healthy Social Security, if you have a pension, if you have annuities already, once those things are turned on, they're never getting turned off. So you're always going to have some minimum level of income. And if that floor already puts you into IRMA territory, like you, Kevin, you're never going to avoid IRMA once it's on. So in your case, yeah, it does make more sense than for someone else to convert a little more now. So great point. We'll take one more question here, just came in. And then given the restrictions on Medicare coverage, do you think it might be worth considering getting private insurance or other alternatives like going to Mexico?
That's a step too far for me to go to Mexico for healthcare. Now, I don't know if you mean you want to live there. I know some people do that. That to me would just be, it would be giving up too much of the social network and frankly, family to do that. Private insurance, you're going to have to be pretty wealthy to pay for private insurance as a 70, 80-year-old. And opt out of Medicare, if it's even possible. I don't even know if people underwrite those policies. Maybe they do. But look, Medicare is not that challenging. You just need to navigate it properly. You can always do Medicare Advantage, which is great for people because it's much lower cost typically than Medicare plus a Medicare supplement. So that's one alternative you have. But through the supplements, if you get a good Medigap policy, you can take care of all of those copays we were talking about. It's just many people don't do it. They're trying to save, what are the premiums now? I think 150 or so a month on Part B.
170, actually 171.
170, yeah, it went up this year. And then a Medigap policies probably average about the same amount. It obviously depends on where you live. But still, when you add all that up, it's still $300 or $400 per person. You can have good coverage. So just make sure you do.
The figure I use, and this all depends on where you live, what part of the country, et cetera. But I assume $5,000 a year in today's dollars for Medicare premiums alone. That's the base Part B of 170. Assume you have a Part D drug plan, which averages about 30, but there's different ones you can choose from. And a fairly comprehensive Medigap that sits on top of Part B. And I'm assuming $200 a month, a little more for that, just to be conservative. So all in per person, that's like $5,000. Plus, again,
$5,000 per year.
$5,000 per year per person for premiums plus Medigap premiums. But then again, dental, vision, podiatry if you need it, hearing aids, etc. Now, a lot of people do pay that out of pocket, I see. Now, generally it's okay, barring major dental work or something. A few cleanings a year isn't that expensive, and it's cheaper just to pay out of pocket than get insurance in most cases. But it's the big stuff, the big ticket items that, that'll take a chunk out of your pocket if you're not insured. So anyway.
That's one of the other advantages of Medicare Advantage is often you'll find the insurers include coverage for dental and vision and some of those alternate things. Even gym memberships are included in some Medicare Advantage plans. So that's a good way to go and especially if you've been in managed care for most of your career. In a lot of states, that's all that they have basically. If you're in California, you've been in an HMO. The chances are good. So that's what Medicare Advantage is. So it's not that big of a change to you.
Yeah. And like you said before, it's best to work with, Medicare specialists. Now, these are people who sell policies. They sell supplemental insurance and managed policies. So they're paid by way of selling those policies. But nonetheless, it's their job to specialize and know this stuff. And a lot of times these policies will change year to year. The coverage, the doctors, the drugs that are covered. So unless you want to make it darn near a full-time job, keeping up and researching all this stuff, it's usually in most people's interest to work with a specialist because that's all they do. They live and breathe this stuff, and they'll help you figure out the best plan or combination of plans for you based on where you live and your drugs and your doctors and your ailments and whatever. So, all right. Well, thank you, Kevin. Any parting words of wisdom? Not to put you on the spot. Parting words of wisdom, or we'll just wrap this thing up here.
Yeah, forget about all these risks. Retirement's great.
Heard it from the source right there. There you have it. No need to plan. Just do it. Just retire and wing it, right? No. Okay. Well, thank you very much, Kevin. Pleasure as always. Thanks for being on. Just stick around for a moment after I cancel here. And thank you, everyone, for watching. Take care. We'll see you next time.
Thank you.